Thank you very much, Christian. Thank you, Wim. Thanks to the European Banking Federation for having me here today. And I'm also welcoming the fact of having a focus of our discussion not only on the day-to-day issues of the pandemic, but also trying to look beyond the pandemic and let's say trying to understand what would be the challenges as we now, let's say, start bracing for the impact of the pandemic and prepare for a new normal, both as supervisors and as banks. When I consider the first two phases of the SSM response to the pandemic, I mean, they're being widely covered in recent debates, but let me briefly recap some of the steps which have been accomplished so far to move then ahead on the phase where we are now and what is going to come next. The first response to the shock saw a very rapid, I think, and effective and unified actions across the euro area, something that was pretty much unthinkable before the establishment of the banking union. And there have been two main guiding principles behind our action, and these have been supervisory relief and capital conservation. The supervisory relief action has come through the release of buffers that has been effective, I think, to prevent a sharp tightening of credit standards, which has been on a much lower scale than previous crises. We extended also operational relief to the banks and temporary flexibility in relation to the management of NPLs and loan loss provisioning and loan classifications were also interpreted in such a way to accompany and smoothen the implementation of the national loan guarantees and the loan moratorium programs that have been deployed on an unprecedented scale. We've seen value in making full use of the microprudential tools during the first phase to contribute to the overall financial stability across the banking union. And this is a new development to some extent that I would like to highlight here. Market-based evidence shows also that the combined monetary policy and supervisory response helped keep the bank sovereign adverse loop that we have seen in previous crises at bay, and which is also, in my view, a remarkable result. The second leg of these intervention has been capital conservation, which I understand has been a bit less well received by the industry. And this is basically the action which has been taken to ensure that no capital is flowing out of the banking sector. So basically the recommendation to banks to refrain from distribution of dividends and buybacks of capital. It's clear that the unprecedented scale of the support measures, government guarantees, monetary policy financing, supervisory relief, and the unprecedented uncertainty both on macro and on the macroeconomic developments and on the asset quality developments were strongly, backing, in my view, the need for these interventions. In the second phase that finished basically around July, we moved to the assessment of risk, vulnerabilities, and potential impacts of the pandemics on the bank's balance sheets. We conducted a desktop-based analysis to assess the potential vulnerability of significant institutions under two scenarios. One was let's say, the central scenario developed by the ECB staff in terms of macroeconomic projection, and the other one was a severe but plausible scenario linked to the possible continued contagion after the summer and possible new rounds of containment measures. The results of these analyses showed an overall resilient banking sector, well positioned to withstand also a deep and abrupt recession like the one that we have been experiencing in the recent months. But it also indicated the potential for material tail risk. And under the more adverse scenario, which remains plausible in light of the I hope that everybody is hearing well. So basically, under this severe scenario, capital depletion could be material, a decline of 5.7 percentage points in the Common Equity Tier 1 ratio on average, and non-performing loans could soar to a very high level, even 1.4 trillion, according to our estimates. Perhaps most importantly, in the interaction of our joint supervisory teams with the banks, we assessed a very high level of uncertainty prevailing even in the estimates of the banks themselves. And this was reflected in very diverse capital planning assumptions, too dispersed and sometimes optimistic estimates of the cost of risk, and the widespread tendency to refrain from reclassifying assets. So we sent a letter in July, and this concluded this second phase, asking banks to step up their operational capabilities to, let's say, manage an impending deterioration of the asset quality. And also we, let's say, decided to extend our recommendation on capital conservation issues. And we think that all these measures have proved, let's say, effective in a sense that we also registered the intention of euro area banks to expand in the aggregate loan books and risk-weighted assets by the end of the year. So the support to lending was effective. Now let's move to the present and look ahead. If you look at the September macroeconomic projections of the ECB, basically the picture has not changed a lot with respect to June. It has slightly improved on 2020 and slightly deteriorated for the following years. But let's say the reality is that economic activity remains far below pre-pandemic levels, and the recovery is asymmetric across sectors and countries, and there is still a lot of uncertainty around the outcomes. There is, of course, also some good news. The summer has shown some rebound in consumer spending and business investment, but again, the potential for high costs associated with a severe scenario remain very high. At the current juncture, and I would like to underline this, our supervisory strategy has evolved into a new phase. On the one hand, we think it is time for banks to brace for the impact that will likely materialize as the system-wide moratoria are lifted, and the first moratoria started being lifted yesterday, actually, in some member states. On the other hand, a proactive attitude on all sides is needed for the pandemic not to act as a mere amplifier of long-lasting and well-known structural deficiencies. Actually, rather, it should serve as a catalyst for a stronger banking sector to emerge in the future out of the crisis. So let me try to focus on these 2 points: the bracing for the impact, let's say, and the building of the new normal. Let me phrase it like that. So far, we have not seen a lot of the effect of the deterioration of asset quality materializing in current supervisory reporting in the data. This notwithstanding, we think the bank should not postpone their fundamental risk management duty of early identification of arrears, case-by-case reclassification, and prudent provisioning choices at this juncture. Borrower-specific debt restructuring and forbearance practices must be used to single out viable distressed customers from non-viable ones. And the available flexibility and tolerance that was introduced with the moratoria was indeed very justified. But as we approach the expiry of most of those programs, all efforts should be put in place to avoid a cliff edge effect at the end of the programs. We're currently reviewing the bank's responses to our July letter, and we plan to gradually intensify our scrutiny of banks' preparedness to deal with the impending deterioration in the quality of their assets. And solid credit risk management practices and prudent provisioning outcomes are particularly important. Of course, this would enable us also to capture in the coming weeks and months a clearer picture of the trajectory of asset quality, which is necessary for us to inform our decision on the recommendation on dividend payments, which we plan to complete in December. Sometimes I hear that the pandemic is used to question the implementation timeline of the forthcoming standards, for instance, on the definition of default, or for maybe reviewing the application of the legislative backstop and NPL coverage. And I think that this, in my view, shows that maybe the lessons of the previous crisis have not been learned sufficiently. The sooner NPLs are identified and provisioned for, the faster and the smoother will be the process for NPL resolution and disposal, which will avoid a damaging hangover down the road. We know from experience that delayed recognition and poor management of deteriorating asset quality may easily clog the bank's balance sheets and with NPLs for a fairly long period of time, impairing their ability to support viable customers and buttress the economic recovery. Second, there is also the point that the portfolio quality is a main driver of value creation at banks in the current environment, and analysts and investors have already revised upwards their expectation in terms of cost of risk for 2020, and have accordingly revised downwards their expectations on bank profitability. And postponing the adjustment, I think, would not help banks reestablishing themselves and recovering their role as attractive investment opportunities. So I think that is not a moment to review rules or policies. It's actually a moment to focus on the effective implementation. And I think the right time to do that is now, before the impact, rather than after the deterioration of asset quality has actually occurred. Of course, while banks do their share of to tackle the asset deterioration, authorities have also to do theirs, and I very much welcome the remarks that the Vice President of the Commission, Dombrovskis, made a few days ago on policy actions to further improve the function of the secondary markets for NPL sales and NPL securitization, and also promoting a more integrated use of asset management companies across the European Union. So I think these tools are necessary to shorten the time for dealing with the problem this time compared to the past. The second point I want to raise is that the European banking sector has been caught by the pandemic shock in a condition of structural weakness. There is a persisting problem of low profitability driven by excess capacity, low level of cost efficiency, which has, of course, accompanied through time bank valuations to historic lows. And addressing these structural issues becomes, in my view, even more urgent in light of the likely effects of COVID-19 and of the policy responses which have been adopted by the authorities. So following the shock, a low interest rate environment is going to prevail for a longer period of time. And we have done recently interesting analysis showing that in these particular circumstances, and especially after the shock, banks which had a good level of asset quality and which had taken more decisive action to boost non-interest income have been the ones which have been able to better, let's say, perform in terms of profitability. So the efforts to reshape the business model and to achieve these results are more important than ever, I think. And they can also be supported by investments in digital technologies, having seen that also during the pandemic, bank customers have shown interest in new, let's say, in the new digital banking solutions which have been developed. And the banks have been very effective, actually, in terms of managing staffs, premises, and branches during that lockdown. So this could open a lot of space, and I know that many banks are reflecting on the future of their distribution networks and on how to improve their cost efficiency. And we will accompany this process to our business model analysis in the supervisory review and evaluation process. In this quest to restore profitability, banks should also consider the possible benefits of business combinations. Reducing excess capacity via consolidation, for instance, could reduce also these elements of unhealthy competition, which we have seen in place in the last couple of years, in which we have had a lot of drive for volume lending and race to the bottom type of behavior. I think that the survey on credit underwriting standards that we published in June highlighted some of these issues. And dealing with this could also help reestablishing sustainable levels of profitability. The experience of other jurisdictions shows that in the aftermath of large shocks, healthy levels of orderly exit from the market via consolidation, for instance, are a key ingredient for the pace and success of the recovery. And even in this case, as banks do their share, supervisors and legislators should also do theirs. And we recently published a consultation document refreshing the SSM approach to the supervisory assessment of consolidation transactions, exactly in that spirit. And targeted harmonization could further the integration of the European single market, for instance, by identifying and removing territorial elements in the current rule book that represent an impediment to cross-border consolidations, mergers and acquisitions. And it is, in my view, essential also that the legislators work for an integrated crisis management framework more conducive to facilitate smooth exit from the market, also for mid-sized banks that would currently be subject to very diverse national arrangements. Let me also mention in closing that the COVID-19 pandemic should not be seen as the occasion to question the validity of the recently finalized international prudential framework. Basel III has been a very difficult journey. You know that many of the proposals there are to fix weaknesses in the regulatory framework, which have been identified first and foremost by European authorities, and it has been negotiated with our international counterparts for a long while, achieving what I think is a balanced and satisfactory conclusion. And it entails a long phasing in of some elements, such as the output floor, which are particularly painful and for some European banks. And so, notwithstanding the challenging moments we are living right now, we need to maintain a longer view, a longer time perspective, and continue strengthening the framework. So, summing up, our supervisory strategy is continuously adjusting in accordance to the challenges raised by the pandemic. Our primary effort today is to make sure that banks adequately prepare for the immediate impact of the COVID-19 crisis, especially on asset quality. But as Churchill observed, kites rise highest against the wind, not with it. So we should take the opportunity to make our banking sector emerge stronger from the pandemic. Thank you very much for your attention.